to be going over the top four real estate asset classes, at least what we think are the top four. And we'll go through, before we get to that, we'll go a little bit over, what exactly is an asset, different asset classes. Um, Also, a little bit about ourselves. If you're not familiar with Elevate, we're a real estate firm. We focus on acquiring multifamily value add properties. We've currently have around 650 million assets under management. Um, we got a pretty strong team, as you see there in the slide. You've got myself, I'm the CEO, co-founder. Then you've got Eric, who's also co-founder and COO. So he works on the daily operations mainly. You've got Brian, who you see here as well. He's our CIO. Um, Nick Bowden, who is our senior analyst slash acquisitions. He's great with the numbers. And if you've seen some of our other webinars, he's gone through the underwriting and whatnot. I think he'll be on next week. We're going to be going through a case study. So make sure you guys sign up for that one as well. Then we got Joel, who is our director of asset management. He deals with our existing portfolio and making sure we're executing on the business plan and that we are doing everything we need to be doing on site at the properties. Then you got Mina, who you see here as well. And if you invest with us, you've probably spoken to Mina. He's our investor relations, takes care of the investors and makes sure they've got everything they need. Then you've got Tessa, who is our COO on the management side of things, on the property management. And then Mike, who's the CEO as well on the property management. We've got some other team members within the construction company and some other support members as well. Some of the numbers, as you see there, we got a ton of combined experience at this point. Multifamily units, we've acquired a little bit over 7,100 units. We've exited 1,823 of those. On those exits, we've got an average IRR that we've delivered to our investor at 47.7%. And like I mentioned, we've got 650 million in assets under management. We're vertically integrated, like I mentioned on the slide before. We have a couple different arms. So Elevate is the real estate arm. Then we've got Equity Real Estate Management, who does the property management, and then J&T Construction, who does our CapEx renovations and all of that. So having that vertically integrated, we've worked really hard to get to this point, and it gives us a lot more control of the properties, flexibility, and speed really to be able to implement our business plan when we take over a property. For instance, we just got an LOI signed on a new property, and we've already got all these different functions are working on this. We don't even have a signed PSA yet. That's why I'm not really saying much about it. But we are pretty excited about the deal. And, we already got the due diligence scheduled. Management company's been up and down on it. So really helps to be vertically integrated. Okay, so what is an asset class in general, right? Not just real estate, just in general. Most of you are probably familiar with the securities, right? Where you have your stocks, your bonds, your mutual funds, the stuff that your retirement plans usually invest in, um, your annuities, and then you've got the special one, the alternatives, right? Where um, it's not always as easy to gain access to these. One of them being real estate, which is the one that obviously we focus in. Um, myself, I have some investments in crypto as well, and there's aviation, private equity, etc. Um, so I mean, all of these can generate returns, right? All of them are subject to outside variables as well, right? We all know that the stock market can crash, and we've had is instances where you've lost or the market has lost billions of dollars, within a day. Um, Same with real estate, right? There's downs and ups in real estate. So all of these have their pros and cons. So why we think real estate out of all those choices is the smartest. Um, so first of all, it's produces cash flow, right? So the assets we're buying are cash flowing assets. Um, we use leverage, what I like to call good debt in this instance, that then allows us to bring in our investors and gain higher returns because we're paying, a cheap amount on that debt, and we're able to leverage it and then bring in investors to make up the difference. You gain equity within the real estate when you invest in real estate. You have an asset that's appreciating, whether it's over time or if it's forced appreciation, which we love, which that's, when I say a value add multifamily properties, that means that there's value we can come in instantly and force that appreciation, force the value to go up on the property, essentially by making the net operating income higher. Great tax benefits. We do cost seg studies on all our multifamily properties, which allows us to accelerate the depreciation, which we then give to our investors as well. They share in that depreciation. So it's got some amazing tax benefits. And then you've just got really strong fundamentals in real estate, especially in residential and multifamily. Everybody needs a roof over their head. If you look at the supply and demand, for the most part, especially in good markets, you've got a low supply of real estate. So that's why we like real estate. Now, as far as within real estate, there's a ton of different asset classes, right? It's very easy to um, get distracted with all the noise within real estate itself. So just to break these down quickly, right? So you got your residential properties consisting of single family homes, multifamily units, condos, townhouses. Um, you've got can almost even put build to rent in here now as well, which we do like those where you've got a cluster of single family homes and it's ran more like a multifamily versus just a single residential property. Then you got your commercial properties, quite a bit of different sectors within that. So, I mean, you've got your office, your retail, your hotels, warehouses, self-storage, um, probably even a couple others you can throw in there. Let me see. Okay, so we got more real estate asset classes. Then you've got your industrial. Within industrial, you've got factories, distribution centers, warehouses, logistics centers. Industrial, we'll talk about that a little bit later, but that's really blown up over the years as well, especially with e-commerce and everybody buying everything online, right? Versus actually going to the store. Then you've got mixed use where you've got a couple of these on the same property, right? Where you've got, let's say, retail down at the bottom, and then you've got multifamily on the second, third story, whatever it is. That's a mixed use real estate. You got some specialty ones, right? Like healthcare, educational, um, churches, recreational properties. And then you got good old land, right? Raw land, or, it could be in some phase of development, right? Okay, sorry, let me go. Oh, shoot, how do I go back? Okay. So yeah, each of those real estate asset classes, I may have missed some, right? There was a lot there. All of those have their pros and cons as well. They've got their some are higher risk, some are lower risk. Land is probably the riskiest, especially if it's just raw land, no entitlements. That's probably as risky as it gets. Um, and then you kind of work your way up from there. Now, as far as the ones that we believe are the top four are multifamily, industrial, storage, and retail. And retail took a hit there for a bit, but I do still think it's made a comeback, and there's certain retail that's still a decent um, investment. I guess you can say multifamily, right? We're focused on multifamily, so we may lean a little towards that, but we will go through each of these for you. Actually, Brian, I think I'm taking some of your thunder. So if you're ready, you want to take over?
Yeah, absolutely. Um, I was going to put in the chat, what would you guys rank these top four, one to four? I think we can create a poll. Let's see. Maybe you want to, yeah,
I'm trying. Um,
create a poll.
yeah, I don't use Zoom a lot. I don't
Top
see.
four, I got it. Top four real estate asset classes. Um, Obviously, Elevate CIG is all about multifamily. Within multifamily, we're very diversified. And that's diversified in different markets, different asset classes within multifamily, and that being C class, B class, A class, built to rent. So we do know that there is definitely money to be made in these other sectors of commercial real estate. And some of the actually developments that we've been looking at, some of them will have a retail component. Actually, at one of our multifamily properties in Northwest Arkansas, we actually built more storage units, or are in the process of building garages and storage units on the facility. It already came with garages and storage units, and we're adding that component there. So there's definitely a mix there, between those. Industrial, you don't usually see that crossover with multifamily, but storage and retail, you can see some of these assets that we're looking at has a component of each of those. I own some, George talked about how he's diversified within different sectors outside of real estate. Same with me. I do own a small, storage facility and a commercial strip in my personal portfolio. So I think it's good to diversify, but you definitely want to be doing it very cautiously, and make sure you know what you're getting into in good market. So, all right, I created a poll, I think. Did that work, guys? Do you see it?
I don't see it.
Say bad question. No.
Did we fail?
Questions, top four real estate. You guys aren't seeing that? No. Okay.
Do I need to stop sharing, maybe? I don't know.
Oh, maybe so. Let me take over here. All right. I put it in the chat. You guys can tell us which ones you think. I'm obviously between these. My vote right here, I would say multifamily, storage, industrial, retail. I would put that in order if you were to ask me order of most investable, and as far as risk adjusted returns, I think that's going to be your best bet. Now, industrial has performed really well in years past. And we'll start with industrial. So industrial actually really blew up it's been pretty consistent, but and during COVID, when a lot of movement was going to e-commerce, we saw a huge need for industrial warehousing for a lot of these companies right here. And you can see right here, just in for 2024, the industrial move-ins for some of these large distributors and even logistics companies here. It's been a huge demand for distribution facilities. We have seen on the logistics industry, that industry particularly is in a recession right now. There was a lot of overinvestment in trucks and not as many manufacturers shipping as you would think. So we'll see what happens to the industrial space as well. There's been a lot of investment into the industrial space to capture that extra need for warehousing. It is reliable rental income, which we like real estate in general for. You can see there are some there is land shortages, so that's kind of the argument for any real estate, they're not creating more land, that you can't create any more land. So that is one of the arguments you could have for any asset class there.
Yeah, I think Nicholas just said that ship has sailed. I somewhat agree with that, at least for the time being. It's just so much was built so
Yeah.
fast.
And Richard made the same Amazon is cutting back on logistics after over. Yeah, so if you look at like JB Hunt, they're a big player in Northwest Arkansas. They're one of the, Fortune 500 companies, and they're a public company. So you can see their earnings report. They've been down 2024 and 2023, and it's across the logistics board. So, the one downside of industrial is it does mirror the logistics industry. So when you have a bad logistics industry, then that affects this industrial big time. And there's been a lot of kind of overinvestment in that space, but people have made good money in industrial. I think it's very market specific. And it's also specific to what company is building that industrial space. And a lot of these companies are building it themselves. Amazon, isn't renting out from someone else. They're building that themselves. Similar to some of these other companies, they do a mix of both, but I definitely wanted to talk about industrial. We think it is an interesting asset class. People make good money there. There are risks, especially right now in this particular market. So with any real estate investing, we always recommend to partner up with someone that is an expert in that field, and do your due diligence and get educated on that space. Retail, like George mentioned, that suffered big opposite here for COVID. So COVID, industrial boomed, and retail really, it wiped out a lot of businesses that haven't recovered or haven't even come back. There has been, a lot of recovery, but it took out a lot of businesses in the retail section, and you're seeing a lot of more delivery services where people don't really go into the store anymore, especially for, like clothes or anything. Pretty much think anything you can buy on Amazon, which what can't you buy on Amazon right now? But people still like going out to the store, and people like going to the restaurant. So, restaurant industry has a 50% failure rate. If you're opening a new restaurant, there's a 50-50 chance that you won't make it past the first year. So that's a big component of retail. But for retail to be successful, you really want to have high, like it mentions on this second point, really high visibility, and a lot of foot traffic in that area. There's within the retail space, there is different high income catering to retail, and then, your lower income retail. They can be repurposed. That is a benefit of that too. Where you can come in and turn a restaurant into, a pharmacy, or vice versa. There are some intricacies there, but once you have that space, you can repurpose it. But where you get into there are costs, and they could have cost overruns. Tourism, it can increase the demand for convenient shopping. Smart tech and data analytics definitely help there. You can see there has been a slight uptick in retail sales from the first half of this year compared to the first half of last year. And I'd be very interested to see this data from 2022. I think where 2020, 2021 probably was the bottom of the retail space. So we are seeing it make a slight comeback. Personally, for us looking at retail, there would have to be a major multifamily component. We looked at a deal in Dallas that had 300 multifamily units, and then under it, it had a massage place, it had a smoothie place, and it had a clothing shopping. So the majority of it was high-end multifamily, A class, not the very top, but their thesis there was they would have a lot of foot traffic, and that commercial component would command a higher price per square foot. So definitely one to keep an eye on. Not something that we're specifically going after, but there's definitely money in the retail space. Storage units, this almost mirrors multifamily. You think, as far as risk adjusted returns, people are always going to need a place to live, and that's why we like multifamily. And storage units perform surprisingly well during recessions. You would think actually the opposite. You would think people have less money, so they wouldn't store their stuff, but they're finding a way. They don't want to get rid of some of their stuff, so maybe they're downsizing and they don't want to get rid of their belongings. So an uptick in storage is there. I personally have some storage units in my personal portfolio. I think it's definitely a good risk adjusted return. You're looking at, when you look at any real estate sector, if you look at the past big swings, so the current market right now where commercial real estate is down 20 to 30%, look at COVID performance, and look at 2008 recession. If you want to go back even further, look at 80s and 90s data. But I think those three big swings are important to look at. And storage has remained pretty resilient, but this is also very market dependent. There has been a lot of institutional money that has been poured into storage unit, where the same thing there with some of that industrial, it is, you could say it's being overbuilt. I know here in Northwest Arkansas, there's been a ton of storage units popping up. And I've talked to other storage unit specific investors, and they think that there is an oversaturation there. So you have to be very careful on where you're building and looking at supply and demand. What's the planned development for storage units, similar to how we're looking at, if we're looking at multifamily development, looking at the path of progress there and what the planned developments are. Okay, last but not least, our favorite asset class, and what Elevate is all about, what each one of us is about here, multifamily. So I talked about it before, but people are always going to need a place to live. That's the overarching thesis for multifamily. Especially now when you're seeing people that necessarily can't afford their first time home. more people are looking to rent instead of get bogged down in a home, that they may move again. You're having more people that are more mobile, that are not necessarily moving to a city for the rest of their life. They may be there for 1 to 3 years and then settle down from there. Again, if you look at multifamily and some of the past recessions, you can see it has an element of resilience. And if you look at multifamily right now with and commercial real estate, it is down, from its peak pricing in 2021, 2022. Multifamily valuations across the board are down almost 30%. But still, there's opportunity there to, one, acquire new assets, but two, the assets that you do have an extra layer of resiliency, where it's not the 2021, 2022 return, but you're able to really have that resiliency there and stick it through.
Right.
So
Brian, I also think Jamar asked a question here, and it also brings up a good point. So he was asking, is there one asset class within real estate that banks offer better debt on, which that is multifamily? The most attractive debt you can get is on multifamily, which, goes to show if the banks feel the most comfortable lending on multifamily, there's a reason for that.
yeah, 100%. Yeah, if you're calling a bank to get a loan and you're calling about commercial office space or even retail or some of these other, they may say they're not lending right now on that, but most banks' ears perk up when you say multifamily. Now, I would say the majority of banks are still lending on multifamily, but they have tightened up their lending. 2021, 2022, banks were giving 80% loans. Now they've cut down to 65%. Obviously interest rates is a huge factor in that. But some banks are not even lending on other asset classes. So it's a good question and a good, point there, George, about that resiliency. And if you look at if you follow some of the larger equity trusts, institutional type capital, a lot of those investors, were in commercial real estate as a whole, and they were invested in retail and office space and some of these high-rise developments. And a lot of that capital has been redeployed to multifamily. A lot of capital has pulled out of commercial real estate and started looking at multifamily as a more resilient asset class. There is a lot of dry powder sitting on the sideline right now looking for that opportunity, but you have other companies like Blackstone making $10 billion investments, signaling that the opportunity has already been there. So, we talked about some of that as far as market dynamics on some of our past webinars, and we will again about future webinars, but I think you can kind of see the movement in the market based on some of these larger institutional type investments. And I think, George, you put it well there too in one of those webinars, that you don't really see the bottom until it's already happened. So I think multifamily, personally is probably seen as bottom, and we think now is just as good at any time to invest. And it's an asset class I'll be investing in for, the next 50 years. So this is why we think the benefits of multifamily. People are always going to need a place to live. You're having attractive bank financing. You're getting, in a lot of cases, interest only loans where you have more control over your cash flow. Some people make the argument of, I'd rather have principal pay down, but in our case, we like to have the cash flow so we can distribute that to ourselves or put it back in the property. I'd rather have control of that cash flow versus the bank. But if you are on, principal and interest and you're paying down that note, you're not actually paying that down. Your renters are paying down the note, so you're getting that note pay down. You're able to force appreciation. So multifamilies valuations are based on their net operating income, and that is something that you can force yourself based on how you're pushing operations, how you're cutting or stabilizing expenses, how you're pushing income, whether that's through rent or that's through other income, parking, adding storage units like I talked about, getting creative there, finding other income. So that valuation is just like a business. A business is valuated on its bottom line. And same thing with multifamily. Now comparables definitely come into play. You always want to look at sales comparables when you're looking at multifamily to give you a basis. But at the end of the day, it's how much income are you producing and how much income are you expected to produce. So we like that control aspect of multifamily versus other asset classes too. And we really like the tax benefits of multifamily. The cost segregations are great for multifamily. Right now, they are phasing that out. It depends on what happens in November. That could be reversed the other way and continued back to bonus depreciation. There's 1031s, there's opportunity zone funds that you can do for multiple different asset classes. And last but not least, the scalability of multifamily is really built into the business model. That's one of the reasons why I got into multifamily in the first place, was because property management is built into multifamily. You're going to be performing better with property management versus you yourself being active in there screening residents. So that is one thing I didn't want to do when I got started investing, and was not be personally in the operations. That's why we got a great team to do that. It's also built out our own property management company that has its own separate CEO and COO that George talked about. So the scalability is great there. And especially when you get into these larger apartment complexes, 100 units and up, and it pays to have that on-site management, and it pays to have that leasing agent where you can really get the business or the multifamily asset humming.
Yeah, I agree with you, Brian. I do not miss the days of when we had our small multifamily and single family rentals of having to collect rent and the stories I would hear. Yeah, on-site
Yeah,
management for sure.
that'll age you pretty quickly. Like, if you're trying to save, 1% here, your time, once you're getting into this different investing game, your time isn't worth collecting that rent. Your time is better spent figuring out how you can invest more, how you can scale more, and the time's better spent hiring that out and getting someone in place, let alone the gray hairs and no hair that could have caused, maybe that's
No.
why it went bald faster.
So man, we had a question here. As far as the interest rates coming down in like the next 18 months, which yeah, I agree that should be the case. If there's a sweet spot for rentals versus, I guess once it gets low enough, that somebody would go purchase a home versus rent. At least that's the way I understand this question. Um, I think there's a lot of variables there. It's not just the interest rates, right? I think even now we haven't seen single family pricing really come down that much. The volume of transactions has come down a lot. The pricing hasn't really come down, and it's because it goes back to supply. There's still a low supply. And we're starting to see some of the supply build up, and that's really when you'll start um, seeing pricing come down. I don't know. It also depends on the asset class. Some of the residents that are living in our C class properties, they're probably not going to purchase a home, unfortunately. It's just become not affordable for them. There's no way they can do it. And some of our A class, where, even now, that's usually the number one reason somebody doesn't renew is because they're buying a home. Um, that may increase, but then again, we go back to the supply. The population growth in the certain markets that we're investing in is really strong, and the supply is not there. So, um, I don't know if that really answered the question, but yeah, I do think when the rates come down, more people will be able to buy homes for sure. Just um, financially. I don't really think it will affect our investments.
Yeah, I think it's very market specific. I saw a poll recently saying that there was like 50% people in the single family space thought there might be a housing crash, or some sort of correction there. So, if people are paying what they are now, when their
Not if
costs
rates come
go,
down, man. I don't see that happening if when rates come down.
yeah, that's exactly where I was going. Once rates go down, they can afford to pay even more than what they're paying right now. So I would, I one of our friends, Henry Washington, who's very involved in the single family space, and he said, if you think prices are high right now, what do you think when the interest rates are going to come down? Where do you think are going to go? Real estate, residential is going to go. So I think it depends on the market you're in, but yeah, interest rates coming down.
100% of the market, man, because I just feel like if the supply, so the rates come down, then maybe you have others willing to sell that aren't willing to sell now because now they can go buy something else because the rates are lower. So if that happens in a certain market where the population growth isn't there, I can maybe see the pricing coming down in that certain market. But yeah, very market specific, like you said.
All right. I'll let you talk about this. Kate, yeah, so here's one of our more successful exits. And I'll let George talk about this one.
Okay, I thought you were gonna run with it there for a second. Yeah, so this was a great deal. This was like we mentioned markets. This was a market that caught our attention because it was very affordable. There was not a lot. Hey, there's your poll.
Nice.
How did that happen?
Is it on the share screen?
No, I mean it just popped up.
Oh, nice. There we go. It's playing with it still. We're 2 for 2 on multifamily so far.
Yeah. Host panelists cannot. Oh, okay. I can't vote. It's just showing me that it popped up. Got it.
Yeah, so it's yeah, we're not even skewing it.
Okay, so back to this case study. So we pinpointed that Augusta was experiencing some population growth, some serious job growth, and it was still very affordable. Um, so we acquired this 104 unit apartment for 50,000 per unit. We came in with a pretty straightforward value add business plan. We were going to upgrade 25% of the interior units, and we were going to completely revamp the exteriors, do a rebrand. This owner that we bought it from had owned it for over 10 years, and um, they had made their money off of it and just were not really putting much back into it. There was a lot of deferred maintenance and whatnot. So we budgeted right around 1 million in capex. And then, like I mentioned, with the vertically integrated, we were able to get to work really quick on this. You can go to the next, Brian. I think you're controlling the, yeah. So within 6 months, we had put that $1 million to work. We had upgraded that 25% of units. We had, as you can see with the after pictures here, we had rebranded the property, changed the name, new signage, painted all the brick. We replaced some of the roofs. We did some plumbing work. We just really made it a completely different property. Um, got higher rents, obviously, for those 25% of the units that we upgraded, but then also on the renewals, we're able to get up to market as well on the units. And we put it back on the market after we, call it, I think it was in the ninth month of owning it or 10th month of owning it. And then we closed it literally on the 1 year mark for 104,000 per unit. So we were able to give our investors over a 2x multiple within 1 year. So it was pretty crazy. We were in a hot market, right? So this isn't every single deal doesn't go out work like this, but it did help that we were able to execute that business plan quickly. And this is essentially a lot of our business plan on several of our investments. We have in the past 3 years or so, we have started doing more A-class products from we like buying straight from developers, and we're able to come in and just manage them better than they are. A lot of the times these developers are just looking to build it, get it filled up and sell it. So we're able to really come in and maximize the NOI and maybe not do as much heavy lift on the CapEx side of things.
Yeah, I was talking to an investor today and he was asking about like our business plans and saying, do you buy value add or A class? And I think, value add is really associated historically with the C class properties. We're talking a lot about asset class, but within multifamily, you have C class, B class, and A class based a lot about age of the property and rental status on them. And the A class properties, there is a lot of value add when we are buying directly from developers. Um, we're able to come in and stabilize expenses and push income because they're just worried about getting it leased up as quickly as possible. They have a construction loan, high interest construction loan, and usually, a couple of different equity partners, usually larger, that are trying to get out as quickly as possible. So they're not really operators, they're builders. They're great at building, but operation is not their MO. And that's where we can come in and add value by implementing that business plan, putting in our professional property management. That's all they do. And then finding other areas for income from there. And then you're left with a stabilized, after you've come in, you have this new asset that's stabilized and that's producing good income with relatively lower expenses on because of the age. And then you can in turn sell it to a more institutional type investor, who are looking more at the A and B class opportunities. But that's not to say we won't buy the C class that you're looking at right here. We're built for it. We have our own construction company. It's just hard to get these deals to pencil. We're still offering on these kinds of apartments, some of the newer ones. So just the price has to justify us to come in there. And you want to be conservative on your underwriting there, with some of the C class residents getting hit harder, especially by inflation, having to keep up with the cost of goods of pretty much everything else too. Okay.
You want to go to the next?
Yeah, any questions about our case study, let us know. So this is our current and only investment opportunity with Elevate. It's a passive income. You can go to the portal to get a more information on the passive income and get a replay. I think, Mina, we should put the replay link in the portal. Now that I'm thinking of it, when you go in to click on passive income fund, that'd be good to have that webinar replay on the passive income fund. You know what I'm talking about on the summary?
Yeah.
Yeah, so we'll have access to the last webinar. We'll put that in the portal there. It's a really good vehicle, especially for you are familiar with more of the hard money lending or short-term money lending. It's a really nice way to get steady monthly income. So we're invested in it personally. We have investors in it. So the one caveat there is you're not getting any depreciation benefits. You're not getting any tax incentives there because it is an interest income. We're lending with it, so it is treated as interest income. But that's also why you're able to get the 14.5% preferred return, depending on how much you're investing. For more higher investors, we have more returns, but that's why it is so high, and you're able to get that monthly income. So you can go to elevate.invportal.com for more information on that. Yeah, appreciate you guys. Looks like can I share this? Is it sharing? No. Top 4 real estate asset classes, 88% have multifamily. We do have 13% at industrial, storage 0%, retail 0%. So I agree with the majority here. Also industrial's fine too. Next week, we will be having our webinar on underwriting deals. We'll actually go through a live deal. And we may go through a couple. I don't know. George is still deciding whether we're gonna do one case study or multiple case studies. But that one's gonna be really good. We'll have Nick Bowden on again, and we're gonna continue doing these. I'll go back a slide. Someone asked about this. Is it a fixed interest fund? How about growth at the back end? Yeah, so it is fixed at 14.5%. So usually our syndications, you're having a preferred return of 6 to 8. This is set at 14.5%. Half of that is given to you monthly. So 7.25% is paid monthly, and then 7.25% is accrued at the back end. So there isn't growth beyond the 14.5%. That is what you're getting. But to your benefit, you know what you're getting. You also have a lot less risk of not getting anything. You're getting that day one because you're sitting in the capital stack right below the bank and above common equity anywhere from $5 to $20 million below you. So sitting at around 65 to 7%. But good question there. Any other questions on fund? Anything about asset classes? Let us know. But appreciate everyone chiming in and everybody on Facebook Live. Make sure we didn't get any more questions there before we close it out.
Looks like that's it.
All right, guys. We will see you next week if we don't talk to you on the phone. Available for Mina is available for calls, so we'll be sending out the replay. So everyone have a good evening and good rest of your week.